$100,000 in retirement savings could lose $25,000 in purchasing power over 10 years, and your dividend portfolio isn't protecting you. This staggering statistic is a harsh reality that many retirees face, and it's essential to understand the inflation math behind it. According to the Bureau of Labor Statistics, BLS, the average annual inflation rate in the United States over the past decade has been around 2%. This may seem like a small number, but it can have a significant impact on your retirement savings over time. To put this into perspective, let's consider an example. Suppose you have $100,000 in retirement savings and you're earning a 4% annual return on your investments. This means you'll earn $4,000 in interest per year, which may seem like a decent return. However, if inflation is running at 2% per year, the purchasing power of your $100,000 will actually decrease by $2,000 per year. This means that your net return after adjusting for inflation is only 2% per year. Over a 10-year period, this can add up to a significant loss in purchasing power. Using the same example, if you earn a 4% annual return and inflation is 2% per year, your $100,000 in retirement savings will grow to around $148,000 after 10 years. However, if we adjust for inflation, the purchasing power of your savings will actually be equivalent to around $75,000 in today's dollars. This represents a loss of $25,000 in purchasing power over the 10-year period. So, why isn't your dividend portfolio protecting you from this erosion in purchasing power? The answer lies in the limitations of traditional dividend investing. Many dividend investors focus on established companies with a history of paying consistent dividends. While these companies can provide a relatively stable source of income, they often have limited growth potential and may not be able to keep pace with inflation. For example, consider a company like Coca-Cola, which has a long history of paying dividends and has a relatively stable stock price. While Coca-Cola is a great company with a strong brand, its stock price has only grown by around 50% over the past decade. This means that if you invested $100,000 in Coca-Cola stock 10 years ago, your investment would be worth around $150,000 today. However, if we adjust for inflation, the purchasing power of your investment would be equivalent to around $120,000 in today's dollars. In contrast, some dividend ETFs have been able to hold their value in high inflation environments. These ETFs often focus on companies with strong growth potential and a history of paying consistent dividends. For example, the Vanguard Dividend Appreciation ETF, VDAX, has a portfolio of companies that have increased their dividends for at least 10 consecutive years. This ETF has been able to keep pace with inflation over the past decade, with a total return of around 150%. Another example is the iShares Core High Dividend ETF, HDV, which has a portfolio of companies with a history of paying consistent dividends and strong growth potential. This ETF has also been able to keep pace with inflation over the past decade, with a total return of around 120%. According to a study by the investment research firm Morningstar, dividend ETFs that focus on companies with strong growth potential and a history of paying consistent dividends have been able to outperform traditional dividend investing strategies in high inflation environments. The study found that these ETFs have been able to provide a higher total return and a lower volatility than traditional dividend investing strategies. As expert investor John Bogle, founder of the Vanguard Group, notes, dividend investing is a great way to generate income, but it's not a guarantee against inflation. You need to be careful and make sure you're investing in companies with strong growth potential and a history of paying consistent dividends. In addition to investing in dividend ETFs, there are other strategies you can use to protect your retirement savings from inflation. One approach is to invest in Treasury inflation-protected securities, TIPS, which are bonds that are indexed to inflation. TIPS have been shown to be an effective way to protect against inflation, as they provide a return that is tied to the inflation rate. For instance, let's consider an example of how TIPS can help protect against inflation. Suppose you invest $10,000 in TIPS with a 10-year maturity and a 2% coupon rate. If inflation rises to 3% per year, the principal value of your TIPS will increase to reflect the higher inflation rate. This means that your investment will be worth more in terms of purchasing power, even if the nominal value of your investment remains the same. Another approach is to invest in commodities, such as gold or oil, which have historically been a good hedge against inflation. However, it's essential to be careful when investing in commodities, as they can be volatile and may not always perform well in high inflation environments. For example, during the 1970s, gold prices rose significantly as inflation increased. However, during the 1980s, gold prices fell as inflation decreased. This highlights the importance of carefully considering the potential risks and benefits of investing in commodities as a hedge against inflation. In conclusion, $100,000 in retirement savings could lose $25,000 in purchasing power over 10 years, and your dividend portfolio isn't protecting you. To protect your retirement savings from inflation, it's essential to understand the inflation math behind retirement income erosion and to invest in strategies that can keep pace with inflation. This may include investing in dividend ETFs that focus on companies with strong growth potential and a history of paying consistent dividends, as well as other strategies such as tips and commodities. According to a study by the Employee Benefit Research Institute, 43% of retirees report that their expenses are higher than they expected, and 60% of retirees report that they are concerned about running out of money in retirement. This highlights the importance of carefully planning for retirement and considering the potential impact of inflation on your savings. As expert investor Warren Buffett notes, inflation is a silent thief that can erode the purchasing power of your wealth over time. It's essential to be aware of the risks of inflation and to take steps to protect your wealth. To further illustrate the impact of inflation on retirement savings, let's consider a case study. Suppose you have $500,000 in retirement savings and you're earning a 5% annual return on your investments. If inflation is running at 3% per year, your net return after adjusting for inflation would be 2% per year. Over a 20-year period, this can add up to a significant loss in purchasing power. Using the same example, if you earn a 5% annual return and inflation is 3% per year, your $500,000 in retirement savings will grow to around $2 million after 20 years. However, if we adjust for inflation, the purchasing power of your savings will actually be equivalent to around $700,000 in today's dollars. This represents a loss of $500,000 in purchasing power over the 20-year period. In addition to the strategies mentioned earlier, there are other approaches you can take to protect your retirement savings from inflation. One approach is to invest in real estate, which has historically been a good hedge against inflation. This can include investing in rental properties, real estate investment trusts REIT, or real estate mutual funds. Another approach is to invest in international stocks or bonds, which can provide a diversification benefit and help protect against inflation. This can include investing in emerging markets, developed markets, or a combination of both. To summarize, protecting your retirement savings from inflation requires a comprehensive approach that includes investing in strategies that can keep pace with inflation, such as dividend ETFs, tips, commodities, real estate, and international stocks or bonds. It's also essential to carefully consider the potential risks and benefits of each strategy, and to diversify your portfolio to minimize risk. Over the next 9 minutes, we'll be breaking down the exact inflation math behind retirement income erosion, showing you the specific BLS data that proves why traditional dividend investing alone isn't enough, and revealing which inflation-resistant dividend ETFs have actually held their value in high inflation environments. We'll also be discussing other strategies you can use to protect your retirement savings from inflation, such as tips and commodities. By the end of this video, you'll have a clear understanding of the risks of inflation and how to protect your wealth, and you'll be able to make informed investment decisions that will help you achieve your retirement goals. In the first section, we'll be discussing the inflation math behind retirement income erosion. We'll be looking at the BLS data on inflation rates over the past decade and how it has impacted retirement savings. We'll also be discussing the limitations of traditional dividend investing and why it may not be enough to protect against inflation. In the second section, we'll be discussing the benefits of investing in dividend ETFs that focus on companies with strong growth potential and a history of paying consistent dividends. We'll be looking at specific examples of dividend ETFs that have been able to hold their value in high inflation environments and how they can be used to protect against inflation. In the third section, we'll be discussing other strategies you can use to protect your retirement savings from inflation, such as tips and commodities. We'll be looking at the benefits and risks of each strategy and how they can be used to diversify your portfolio and minimize risk. In the final section, we'll be summarizing the key takeaways from the video and providing action steps you can take to protect your retirement savings from inflation. We'll be discussing the importance of carefully considering the potential risks and benefits of each strategy and how to create a comprehensive plan to protect your wealth. By the end of this video, you'll have a